Retail investors tend to focus on the most visible part of the market, prices. Index levels, daily gains or losses, and headline moves dominate attention. When prices rise, confidence grows. When prices fall, fear follows. This is a natural way to interpret markets, but it is not how institutional capital operates. Institutions understand that prices are often the last place where stress appears, not the first. Smart money does not ignore prices, but it does not rely on them alone. Prices are outputs, not inputs. They reflect what has already happened, not what is building beneath the surface. Institutions are far more interested in the conditions that eventually force prices to change. That difference in focus explains why institutional behavior often looks disconnected from retail expectations, especially during periods when markets appear calm or stable. To understand this gap, it helps to think of markets as systems rather than charts. Systems accumulate pressure long before they release it. When pressure is building, the system can still look orderly. Prices can move sideways. Volatility can remain low. Headlines can sound reassuring. But underneath that calm, constraints tighten and flexibility erodes. Institutions are trained to look for those constraints. Retail investors usually ask a simple question: what is the market doing today? Institutions ask a different one: what will the market be forced to do later? That shift in perspective changes everything. One of the most important differences between retail and institutional thinking is how risk is defined. Retail investors often equate risk with volatility. Big price swings feel risky. Calm markets feel safe. Institutions define risk differently. For them, risk is the probability of being unable to respond when conditions change. A calm market with thin buffers is often riskier than a volatile market with healthy margins. This is why institutions are often least comfortable when markets appear quiet. Quiet markets encourage leverage, reduce hedging, and concentrate positioning. When everyone assumes that stability will continue, the system becomes optimized for that assumption. Institutions recognize that optimization for one outcome increases vulnerability to others. Another critical distinction is time horizon. Retail investors typically operate on short feedback loops. Daily or weekly price movement informs decisions. Institutions operate on longer cycles. They look at quarters and years. They understand that structural pressures do not resolve quickly and that prices can remain disconnected from fundamentals for extended periods. Because of this, institutions pay close attention to signals that do not immediately affect prices. Funding conditions are one such signal. Markets can trade smoothly even as funding becomes more expensive or selective. Higher rollover costs, tighter collateral requirements, and reduced balance sheet capacity all reduce the system's ability to absorb shocks. Retail investors rarely see these changes. Institutions monitor them constantly. Liquidity is another area where perspectives diverge. Retail investors often assume liquidity is abundant as long as trades are executing and prices are stable. Institutions know liquidity is conditional. It depends on confidence, incentives, and the willingness of intermediaries to deploy balance sheet. Liquidity can evaporate, not because of panic, but because conditions quietly change. When liquidity tightens, it does not immediately show up in equity prices. It shows up in the plumbing of the system: repo markets, swap spreads, settlement delays, and collateral flows. These are the areas smart money watches closely because they determine how easily positions can be adjusted when conditions shift. Inventories provide another example. Physical inventories act as buffers between supply and demand. Over the past decade, many industries deliberately reduced inventories to improve efficiency and return on capital. This worked well during stable periods, but it also reduced redundancy. When inventories are low, the system has less tolerance for disruption. Retail investors often assume that supply will adjust automatically. Institutions know that adjustment takes time and capital. Low inventories mean that even small disruptions can have outsized effects. When prices remain stable despite thin inventories, institutions see fragility. Retail investors see confirmation. Institutions also focus on balance sheet health rather than headline profitability. Rising interest rates increase the cost of carrying leverage. Even if prices are stable, higher financing costs slowly erode resilience. This pressure does not cause immediate market moves, but it changes the distribution of outcomes. Institutions adjust positioning based on that shift. Another area institutions monitor closely is cross-market behavior. Stress rarely appears everywhere at once. It often shows up first in less visible markets. Currency volatility, commodity delivery premiums, or credit spreads can signal shifts in confidence before equity markets react. Institutions look for divergences between markets because those divergences often indicate that stress is being redistributed rather than resolved. Retail investors tend to consume markets through narratives. Stories about growth, technology policy, or geopolitics shape expectations. Institutions pay attention to narratives, but they do not rely on them. Narratives can change quickly. Structural constraints do not. Smart money focuses on what cannot be easily altered: arithmetic, physical supply, and contractual obligations. Policy intervention is another area where interpretations differ. Retail investors often believe that policy eliminates risk. Institutions see policy as a tool that changes timing and distribution, not outcomes. Policy can delay repricing, but it cannot remove underlying imbalances. Institutions assume that policy buys time, and they ask how that time is being used. This difference in interpretation explains why institutional positioning can appear cautious or counterintuitive during calm periods. Institutions may reduce exposure, increase liquidity, or seek optionality even while prices remain stable. Retail investors often interpret this as missing out. Institutions see it as preparation. Optionality is central to institutional thinking. It is the ability to respond rather than predict. Institutions do not need to know exactly when conditions will change. They need to ensure they can adapt when they do. Retail investors often seek certainty. Institutions seek flexibility. History reinforces this mindset. Many major market repricings occurred after long periods of apparent calm. The warning signs were present, but they were not in the most visible places. Funding tightened, inventories thinned, balance sheets stretched. Prices remained stable until constraints were reached. Institutions study these episodes not to forecast exact outcomes, but to understand mechanisms. They know that systems rarely fail when stress is obvious. They fail when stress is hidden and confidence is high. This brings us to the core insight of this analysis. Retail investors are watching prices because prices are visible. Smart money is watching conditions because conditions determine what prices will eventually be forced to do. The difference is not intelligence. It is perspective. Markets can remain calm longer than many expect. Institutions know this. They are not constantly betting against stability. But they do not confuse stability with safety. They look for signs that the system's capacity to absorb shocks is declining. In the next part, we will examine the specific indicators smart money watches during periods of apparent calm, how these indicators tend to move before prices do, and why retail investors often notice them only after repricing has begun. Not predictions, not timelines, just the mechanisms that explain why smart money focuses on what most people overlook. If prices are not the primary signal institutions rely on, then the obvious question is what they are watching instead. The answer lies in a set of indicators that rarely make headlines but determine how markets actually function under stress. These indicators do not predict outcomes. They reveal constraints, and constraints are what ultimately force prices to change. One of the most important signals institutions track is funding conditions. Funding is the oxygen of modern markets. It allows leverage to exist, positions to roll forward, and risk to be redistributed. Markets can look calm even as funding becomes more expensive or selective. This often happens quietly through higher rollover costs, tighter collateral requirements, or reduced balance sheet availability among intermediaries. Retail investors usually do not see this process. Institutions watch it closely because funding stress limits flexibility long before it shows up in prices. Closely related to funding is liquidity quality. Liquidity is often misunderstood as volume or ease of execution. Institutions define liquidity differently. For them, liquidity is the ability to transact without materially moving the market, even under stress. During calm periods, liquidity often appears abundant because few participants are trying to exit at the same time. This creates a false sense of security. Institutions know that liquidity is conditional. It exists only as long as confidence and incentives remain aligned. When liquidity begins to deteriorate, the first signs are subtle. Bid-ask spreads widen slightly. Market depth thins. Certain trades become harder to execute without price impact. None of this necessarily causes headline volatility, but it reduces the system's capacity to absorb shocks. Smart money pays attention to these early changes because they determine how difficult repositioning will be if conditions shift. Another key area institutions monitor is balance sheet pressure. Leverage does not become dangerous all at once. It becomes dangerous when conditions change. Rising interest rates increase the cost of holding leveraged positions, even if prices remain stable. Over time, this erodes resilience. Institutions track how much leverage exists, where it sits, and how sensitive it is to changes in funding and rates. Retail investors tend to focus on returns. Institutions focus on survivability. Inventories are another signal that smart money prioritizes. Physical inventories act as shock absorbers between supply and demand. Over the past decade, global inventories across many sectors were reduced to improve efficiency. This made systems more profitable during stable periods, but it also made them less robust. When inventories are low, the system has less tolerance for disruption. Even minor shocks can have outsized effects. Retail investors often assume that supply chains will adjust automatically. Institutions understand that adjustment takes time, capital, and coordination. Low inventories combined with stable prices are not reassuring to institutions. They suggest that stability depends on uninterrupted flow. Institutions ask what happens when that flow is disturbed. Another area where smart money looks is cross-market behavior. Markets rarely move in isolation. Stress often appears first in less visible areas. Currency markets, commodity delivery premiums, and credit spreads can reveal changes in confidence before equity markets react. Institutions look for divergences between markets. When one market signals strain while another remains calm, it often means risk is being redistributed rather than resolved. Retail investors typically consume markets through narratives. Stories about growth, innovation, or policy shape expectations. Institutions listen to narratives, but they do not rely on them. Narratives can change overnight. Structural constraints cannot. Smart money focuses on what is difficult to alter: debt levels, contractual obligations, physical supply, and demographic trends. Policy response is another critical difference in interpretation. Retail investors often assume that policy intervention removes risk. Institutions see policy as a mechanism that changes timing and distribution. Policy can delay repricing, but it cannot eliminate underlying imbalances. Institutions assume that policy buys time, and they focus on how that time is being used. Is leverage being reduced or increased? Are buffers being rebuilt or depleted? This mindset explains why institutional behavior often looks cautious during periods of calm. Institutions may reduce exposure, build liquidity, or increase optionality even when prices are stable. Retail investors sometimes interpret this as being overly conservative. Institutions see it as preparation. They are not trying to time market moves. They are managing exposure across a range of outcomes. Optionality is central to this approach. Optionality is the ability to respond when conditions change, rather than needing to predict exactly when they will. Institutions value flexibility because they understand that complex systems produce nonlinear outcomes. Calm conditions can persist, but when they end, they often end abruptly. History reinforces this approach. Many major market repricings were preceded by periods of stability. The warning signs were present, but they were not obvious. Funding tightened, inventories thinned, balance sheets stretched, prices remained calm until constraints were reached. Institutions study these episodes not to forecast exact outcomes, but to recognize patterns. This brings us back to the central difference between retail and institutional focus. Retail investors watch prices because prices are visible and immediate. Institutions watch conditions because conditions determine what prices will eventually be forced to do. The difference is not intelligence. It is time horizon and system awareness. Markets can remain calm longer than many expect. Institutions know this. They are not constantly positioned for collapse, but they do not confuse calm with safety. They look for signs that the system's capacity to absorb shocks is declining. When those signs accumulate, institutions adjust quietly. By the time prices begin to reflect stress, positioning has already changed. Retail investors often feel surprised, not because the information was unavailable, but because they were watching the wrong signals. The key takeaway is simple, but often overlooked. Prices tell you what has happened. Conditions tell you what is likely to happen when constraints are reached. Smart money focuses on conditions. In the next analysis, we will map out the specific warning signals that tend to appear just before prices are forced to adjust, not as predictions or timelines, but as indicators of where stress is becoming concentrated. Because by the time prices move, the most important shifts have already occurred.